Welcome to The Drill Down, in-depth answers to oil field questions. I'm Richard Spears.
And I'm John Spears.
We appreciate you all having listened over the decades and decades that we've had the podcast out. Today we have a brand new topic, but we just want to let you know at the end of today's podcast, we're going to reveal the winner of last week's puzzler.
Are we going to reveal what the answer was as well?
We will also reveal the answer, and I'm going to read, by the way, my favorite response from a guy who wrote in with his answer.
I can hardly wait. So we'll go real fast through this first part then.
Because everybody's waiting for the answer to the puzzler.
That's right.
And by the way, if you want to know what the puzzler was, we're not going to repeat it.
Right.
Just listen to last week's podcast.
That'll do it. So before we get there, though, what I'd like to talk a little bit about is the state of finances and capital structure for oil companies, because our assumption going forward in our forecast of drilling activity and just sort of how we see the industry is that oil industry's got to be self-financing from this point forward.
I think there's been general agreement that that's the way to look at the industry these days.
Yeah.
And has been for a year and maybe 2 years.
That's right. That's right. And it's self-financing for a couple of reasons. One is there are people who might be willing to lend or give money to companies, but they're going to wait for the track record to get a little bit better. Then there's also clearly a push in certain areas to really sort of prevent capital from being given to the industry, just on the notion of no need to support fossil fuels anymore, right? So the industry's really got a couple of areas where it's receiving pressure to self-finance. And so to that end, we have started tracking the financial performance of 38 different U.S. and Canadian oil companies, 7 different super majors, and 12 midstream companies, all with an idea to sort of see what's going on from a financial perspective with these organizations.
And by we,
I mean me.
That's right, because I've not done any of this work.
So I want to tell you what I've been working on. How's that sound, Rich? No, the idea is, financial structure. What does that mean? So beyond, say, what their revenues are doing, going up and down, the question about what their margins are, what's their cash flow from operations look like, what's their capital structure, and maybe most importantly then to our friends in the oil service industry, what's the capital spending look like from these types of companies? So
yeah, because if you're an oil company and you're barely squeaking by,
right,
you're going to cut way back on everything you're going to do.
Oh, that's been the case starting about 12 months ago, right, for the oil patch, right?
So. Yeah, and it was already happening, just not to the extreme situation.
Yeah. So just focusing on the U.S.-based oil companies we look at, we'll think of those as, or might call them the shale majors. Okay? Devon's in there, EOG's in there.
Would you put Conoco in there?
Conoco's in there, yeah. I'm not including Exxon and Chevron because they're just too big and they're global, right? Yep. But these are companies that, for the most part, are going to be North America focused, right? Because it gives us a little bit clearer picture as to what is happening, what we think might happen with regard to here in the U.S. and up in Canada.
I know that when you reviewed these numbers with me earlier today, I was shocked.
Well, there's some surprising things. So the group of companies we're looking at comprise about a third of the wells drilled, about a third of the oil and gas production here in the United States. So it's a good, healthy, it's not everybody obviously, but it's a good look at a substantial part of the industry.
So even though there's thousands of oil companies producing a barrel of oil a day, this is about 3 dozen.
Yes.
Who represent a third of the oil coming out of the ground.
That's right.
And how much of the drilling?
And again, about a third of the drilling going on as well, right? If you throw in Chevron and Exxon, they together are another 7 to 8%.
So that's half the work, half the oil, half the drilling.
Close, yeah. But again, just these shale majors. Right. So just some top line numbers for fiscal 2020. All right. So we're making some estimates. We're beginning to get the fourth quarter numbers reported. For the most part, right now anyway, that we have estimates of what I think is their results will be. But if we look at those, if we include those estimated numbers for the fourth quarter in there, it looks like as a group, these 30-odd oil companies will, for the year, we'll see revenues down by about 31%, cash flow from operations down by about 37%, and their capital spending down by about 40%. not at all, again, relevant for the year as a whole, right? What's interesting is that the Q4 numbers look
the
like...
one that just ended.
The one that just ended, yeah. Look like this. Revenues will be up about 20% sequentially. So up about 20%.
So from Q3 to Q4,
that's right.
Revenues rose by how much?
By about 20%, I think.
Okay.
Cash flow from operations will be up about a third.
Wow.
And capital spending will be up probably on the order of about 20% by the time all is said and done. So so you can sense the turn in the the income statement, as it were, for these companies.
Do you think that was happening in the third quarter? I'm sorry, from the second quarter to third quarter?
The third quarter was better, yes, and the fourth quarter is building on the third quarter in terms of improvements in revenue and cash flow and all the rest of it.
There's an acceleration going on.
Yeah, capital spending was down in the third quarter, but rose in the fourth quarter. So it's about a quarter behind. What's fascinating is this. I'm looking at the numbers projecting fiscal year 2021, right?
Yep.
Based on a $50 oil price, here's what my numbers suggest.
Ooh, and $50 is kind of where we are.
It's sort of where we are, yeah. So, broadly speaking, use a $50 price, John, see what it is, right?
To the nearest 10.
Yeah.
Okay. All right.
So the revenue numbers for fiscal 2021 for this group of companies will be up on the order of a third, yeah?
For the year?
For the year as a whole.
Wait, okay. Now, already I got to stop you.
Yeah.
Because last year had 4 quarters in it.
That's right.
A pretty good first quarter.
A first quarter that was based on about a $50 oil price. A second quarter that was based on a sub $30 oil price. So we forget from a revenue perspective, and you have to also remember that many of these companies were shutting in production. So they're getting the benefit in my fiscal 21 projections of a $50 oil price and then no shut-in wells. Right?
So you've just said the very first number, revenue. Was it revenue?
Revenue's up about 30
for the year.
Yeah, for the year.
And so that compares it to last year, which had a good, decent Q1.
Right.
And then 3 crappy quarters.
That's exactly right.
So you're saying this year is up from all of last year, which included a really good first quarter.
That's right. Absolutely.
All right, all right, what's going to
cash flow from operations up on the order of about 70%.
Oh, no, that's a real number.
Yeah, think about all the costs that have been taken out and so forth. I think and cash flow was, of course, immensely hit. It was negative in the second quarter of last year. So, so cash flow swings even bigger than revenues.
So what about CapEx?
CapEx
really doesn't matter.
is up, I think, on the order of 25 to 30%. So,
and CapEx would be viewed as drilling new holes in the ground.
Yeah,
installing infrastructure.
That's right. To surface infrastructure to produce that and so forth.
Year over year.
Year over year. Yeah. I think the numbers are looking, they look that way to me. What's fascinating is that the capital spending figures for 2021 as a whole is up. I mean, it's more up. We talk about a 25% rise year over year. But if we look at sort of what Q4 was of 2020, think of capital spending and think of capital spending come for all of 2021, the numbers are up almost double the Q4 rate. Certainly double the rate of the second half of last year.
That's what really shocks me is that for these numbers to be true, the quarters have to really ramp up.
Yes, that's exactly.
It has to essentially look not exactly like, but the reverse of what happened the prior year. Yeah, you just get stronger each quarter.
That's exactly right. Yeah.
So this is just U.S.
That's just U.S., yes. Yeah. I don't have any numbers international from this data set that I'm looking at. But here's the other thing that's fascinating to me. So this group of companies as a whole have about $170 billion worth of debt that they've issued. Okay.
$1 billion here, $1 billion there.
Eventually it adds up, right?
That's right.
Well, here's the fascinating part, that since 2017, these companies, as a group anyway, have not been net borrowers of capital.
Wait, since how long?
Since 2017. Yeah. So they.
Wait. 2018,
2019, and
2020.
Yeah.
They didn't borrow any more money
on a net basis.
They swapped.
Right. They would issue new debt, but often use it to pay back old debt, plus the interest and debt retirement that's normally ongoing. So the oil service companies as a group have actually been sort of self-financing.
Wait, you said service companies.
No, I'm sorry, but the oil companies
right.
have been self-financing for about 3 years now, much longer than what I thought. Yeah, exactly.
Well, okay, so when you think about it,
Yeah.
the peak in activity was really 2018, early on.
Yeah.
And it just kind of sagged and then sagged some more. And then
so here's the other
collapsed.
thing. Here's another stat that speaks to what you just said. So one way to look at capital spending as a percent of cash flow from operations, right?
Yep.
So ignore the bit about whether the industry's financing from outside sources. Just think about what's cash flow from operations, what's CapEx, and draw a ratio between the two, right?
Is it not 1-to-1? Nowhere close.
So 2017, for example,
Okay.
we were outspending cash flow to the tune of CapEx was about 115% of cash flow from operations.
So if I had $1 of positive cash,
Right, I was spending $1.15.
Oh,
yeah,
boy.
right.
Yeah,
So
there's your problem.
that
right
was
there.
a problem right there, right? Here's the numbers for 2018 and 2019.
Okay, hit me
86%. So we were spending.
for each of the years.
Yeah, so if we had $1 of positive cash flow, we were spending 86 cents.
So I'd
on
already actually
CapEx.
cut back.
Oh, yes, exactly. Right. The industry was already amending its ways. And of course, those numbers.
Good job.
Right.
Good job, boys and girls.
Yeah. So here's the deal. In the second half of last year, second half of 2020, capital spending as a percentage of cash flow. Remember, cash flow was hit, but capital spending went down even more. We were, as an industry, we were spending.
We didn't even buy staplers.
60% of our free cash flow. So, yeah, right.
Would your gut tell you that was about as low as it ever gets?
I've never seen it lower, put it like that. I mean, we don't have an infinite amount of data to consider here, but I think that probably represents a realistic low.
It sets up what we always kind of go back to, which is you can't produce oil out of a well you didn't drill. And you're saying here that in 2020 we didn't drill wells.
We obviously didn't drill very many wells, right? But here's the thing I think then that we have to think about is what's that CapEx ratio going to look like in 2021?
Well, that says
right?
everything about what rig count's going to be, doesn't it?
Well, yes. So I think we'll probably, when the dust settles, I think we'll probably see that capital spending as a percentage of cash flow from operations number stay around 0.6. I don't see the ratio rising very much from where it was in the second half of last year.
Oh, really?
Yeah, I think operators are going to hold the line in terms of spending, take all that money, give it back to shareholders, retire
Give it back
debt.
to the debt.
Yeah, because again, these companies as a whole, debt is about 41% of their capital structure. That's probably too high. They probably need to be net retire. You know, we've talked about how they have been not net borrowers of money for the last several years, but they haven't been retiring debt. So I think that's where the focus is going to be.
So they got to get rid of some number. They got to get it to $120 billion or some number.
Right, yeah.
I'm pulling that number out of the hat. That's not a real number.
It's just a guess. But again, capital spending could go up 25% next year, even with
by next year. You mean this year, 2021?
Yeah, but even at these low capital plowback ratio numbers. So
are you going to tell us what the rig count is then?
Well, see, so that becomes the question, and here's my Harry Potter reference for today, right? So in the Harry Potter series, remember at the very end, Harry's trying to
I've never read the book and I never watched the movies.
Oh, well,
so hopefully somebody out there knows.
Yeah. I won't start at the beginning,
okay,
but at the end, he's trying to get rid of the bad guy, and the question is, do I do it by finding all the Horcruxes, or do I by finding all the Hallows? It's a Hallows versus Horcrux decision that they have to make, right? And
it's
for us, yes, right, yeah. For us, the issue for 2021 is: does the industry keep rigs busy, or does it complete the drilled but uncompleted wells that it's done? Right? Yeah. So what's the mix of?
In Harry Potter, did he have to choose one or the other?
Well, he ended up doing both.
Well, you gave the story away.
Well, see, but that's kind of the issue here
that's
for
what
us.
we do here, though.
The question is, the money that operators are going to spend, do they spend it keeping rigs busy, drilling new holes in the ground and completing those wells? Or do they drill some new wells, but then spend a lot of money completing wells that have previously been drilled, right? And so the scenario that we've put forward has been that we'll have about 400 rigs working in 2021, but we'll also pull down our uncompleted well count by 1,000 rigs or 1,000 wells or more. and that's how we'll keep production flat and so forth. But it could very well be, and as we've looked at rig count over the last, 8 weeks or so, it's continued to climb. And it could very well be that operators are telling us, guess what, there's not a bunch of uncompleted wells for us to go off and bring online. We really need to drill a bunch of wells in order to maintain production. And capital spending going up 25% would suggest to me that we might see 500 rigs working this in 2021. So a substantial improvement, I might say, from where we've been. Yeah.
Well, we're going to come back and review this.
That's absolutely right.
When we hit 500 and see just how prescient
I think that's right. Anyway, it's fascinating to look at the financial health of the oil companies and use that to try and understand what their decisions might be with regard to their capital spending plans. So,
okay, so I think that brings us then to the answer to last week's inaugural puzzler.
That's right.
And I know that there's some people who've only listened to the podcast this far so they can get to this answer because we had so many people give us answers.
Oh, I think we got the first answer within 5 minutes of the end of that broadcast.
Which means they chose to not listen to any part of the meaty part, and they went right to the puzzler.
There you go.
But we got so many answers, and like we said, we're going to pick the winner from the pool.
That's right.
Of several that we got emailed to us. But before we tell the answer, I have to read you my favorite response that came with the answer.
Yeah, what is it?
And it was this. In response to your inaugural puzzler, I would suggest you have a top-heavy organization. And because here's a summary of the puzzler. And if you want to listen to the actual one, just go back and listen to last week's puzzler. But it was this: 3-story office building. And you're on the top floor with your team. I'm on the middle floor with my team. Chris is on the first floor with her team. And there's a tornado, heavy rain. We each the disaster strikes. And in the morning, the rescuers come. And of the 12 people that started out in the building, 12 people emerged the following morning. But 4 from each of the 3 floors.
And the question was, how many were on each floor at the start?
And so the answer to last week's puzzler is what, John?
Well, there were 7 on the top floor, 3 on the middle floor, and 2 on the bottom floor. So
and if you want to know
for a total of 12.
That would be, they add up to 12. And ended up with 4, 4, and 4, but it starts with 7,
3, and 2.
3 and 2. And I think, are you going to shoot an instruction video?
I'll put an answer form out there for folks can see how it works.
Yeah, because you can draw a building and
that's how you did
it. That's how I did it. But you actually did.
So who's our lucky winner?
So the lucky winner is Tom Kearney. Good job, Tom. As a loyal fan, you are the first winner of the puzzler contest. We don't actually have a prize yet,
but I think from now on that prize will be just named he receives the Kearney prize. Whoever gets the
the Kearney prize. That's exactly right. So it's either Kearney or Carney, and we're going to find. You need to email us how that actually did. So, and the email here is drilldownshow@gmail.com. But I just want to let you all know that next podcast we'll be introducing a brand new puzzler.
Absolutely. And
then a week after that, we'll be giving the answer to that. So I have here, if you're watching on the video, I have that next puzzler written down, and it is it's one of my top 2 favorite puzzlers of the podcast.
Wonderful.
Anyway, thanks for listening to The Drill Down. I'm Richard Spears.
And I'm John Spears.